We have Knippa. He's owner of Lotus Brokerage Services. He actively trades index futures, currencies, and commodities at the CME Group in Chicago. Also with us right here in our New York studio, Tobias Levkovich. He's chief U.S. equity strategist at Citigroup. Tobias, good to have you here with us.
Nice to be here.
As well as you trade. Tobias, great month for December. Equity's doing pretty well this year. Did well last year. Does it continue?
Our sense is it will continue, but in particular, we're going to see a stronger first half of the year, and then probably a number of problems probably come in and kind of make this the same type of volatile, bumpy ride that we've experienced in the past year.
Because your forecast for next year is certainly not as upbeat as a lot of other folks. I mean, some folks are looking for another double-digit year of gains, but you're a lot more restrained. How come?
Well, we've said this 1,300 is a conservative target, so it could edge its way up. But right. on the side of margins in particular, that's our biggest fear, is corporate margin. This is what I would call an endogenous risk. Our lead indicators suggest that corporate margins will probably peak out around mid-year and then start to weaken as the year progresses. And markets really do care about that. So initially, we got jobless claims today, for example, showing good data. I think you're going to see a lot more of that in the early part of the year. And then as margins start to edge off, people will start to get nervous again. So markets rally hard initially and then back off.
Well, I was going to say, I was just speaking to small business owners when I was out in California, and they were saying that it's been interesting with the margins issue because for a lot of business owners out there, they have kind of been eating it themselves for a while now. They have not been passing those price increases, which have been going up because raw materials are going up.
Right.
So, one of the things I want to say is that, for guys out there, say with Tobias and Trey, maybe this out to you here, do margins mean that much to kind of what's going on here in this overall picture, Trey? I mean, obviously we see a lot of things like, earnings and revenues, as the forefront there. But if margins really are going to start kind of going down, is that a cause for concern?
Well, it's got to be a cause for concern. I happen to be in that camp of being very bullish, like to the neighborhood of 15 to 20% rise in equities into 2011. However, I will put a big however right in the middle of that statement. I have two words that I'm going to be focusing on for maybe opportunities to try to get short or maybe not be quite as long, and that is food and energy. If we continue to see food and energy prices work their way higher, most notably in the grain markets, and that kind of trickling down into foods, if crude works its way back up towards 100 or goes over it, that could really start to squeeze margins. More importantly, you may have, one of the reasons that I happen to be very bullish equities is I don't see any major changes in policy coming from the Federal Reserve. I also don't see any major changes in policy coming from Washington, D.C. I think that we're going to continue this gridlock rally, that we're not going to see a lot of regulatory changes, things like that. I think Washington for a while would just set them aside on the East Coast and they'll bicker amongst themselves and the market will keep working higher. However, if the Federal Reserve does look at these margins getting squeezed and does look at this sort of not necessarily a CPI index kind of inflation, but this food and energy inflation, then if the Fed were to change their policy and they start changing their attitude maybe about liquidity and maybe about interest rates, then I will completely turn the opposite direction on my stock picks.
Well, and Tobias, just quickly here, I'm curious. I mean, if these food and energy prices go up and if the economy continues to get better, why won't companies be able to pass on more of that cost to their customers and sort of hold on to their margins, at least in some measure?
Well, I think there's resistance to price increases. There's also the potential for margin umbrellas, if you want to think of that start to develop and people come under those umbrellas and start to undercut them to gain market share. We've seen that in a lot of industries, but I think the biggest issue, and maybe where I kind of disagree with Trey a bit, is that there's too much focus on food and energy as an area for inflation. Only 7% of corporate costs comes from commodities. 70% comes from labor. If we start to see some labor cost increases develop, that would be your big problem on margins. It's got very little to do with the price of wheat is, or for that matter, for gasoline.
Trey, Tobias brings up a good point. I'd love for you to address that.
Well, first of all, you beat me to the punch. I was going to agree with you about, well, what's the first way to cut margins? Start hiring people. I mean, clearly that would cut into margins. What I'm talking about is more on the consumer side of things. Clearly, if food and energy go up, then it's going to be what the impact is on this consumer, not necessarily what it's going to be. I agree with them. I realize that that's a very small part of the bottom line. Heck, interest rate expense is probably a larger part of the bottom line than necessarily just food and energy. I'm just saying watch that from the consumer side of things because it may have the Fed change their policy on interest rates.
And Tobias, we've spent so much time this week talking about what happened over in terms of holiday sales over the retail season. Everybody was very upbeat. It looked good. The consumer's back. Yay, all that good stuff. But if the psychology changes and we're paying more for food and energy, which we already are, and that changes the consumer sentiment, or could it change consumer sentiment significantly to kind of change things?
You know, again, one of those great myths around the other is that food and energy determine consumer spending, or even for that measure, housing prices do. The top 20% of American income earners own 90% of stocks. They also control 50% of discretionary spending. There's very uneven wealth and very uneven spending. They're watching their portfolios. Yeah, my gas price went up $1,000 this year.
So wealth effect more important.
But my 401k went up $10,000. I'll go spend a little more. That's more important than their gasoline fill-up.
But they're not necessarily going to feel that next year, in your view?
Well, if we get a strong start to the year in markets, which I think we will,
right.
and I'll give one caveat here in a moment, but if we get that, people will still feel enthused about what's going on in their portfolios, particularly those more heavy spenders in the economy. So GDP looks okay in that environment and becomes a reinforcing phenomenon. You probably get some jobs, probably get some margin issues. Here's the caveat. Well, this week, it actually got reported today, for the first time since April, we saw inflows to equity mutual funds for U.S.-oriented funds.
Right.
The last time we saw that was April, and the market corrected. The individual investor has been coming in very late to the party, and that's usually not the best of signs.
You look like...
Why is it?
It's funny.
Go ahead, Trey.
You had mentioned before that one of the principles that you were operating under was that we would see some increases in the economy. What I'm saying is that one of the most bullish things that we have is the fact that the jobless numbers aren't the unemployment numbers aren't necessarily getting better. I'm saying that will keep Fed policy, that'll keep U.S. government policy, it'll keep lots of liquidity, it'll keep us awash in liquidity, and that is going to be the most bullish factor. I'm not friendly to the economy at all, and I think as we consider it kind of sputter along, that makes me that much more bullish the equities. I realize that sounds counterintuitive, but as long as we continue to see kind of sluggish growth.
Well, I don't disagree about the idea of, and I love the idea of Washington bickering amongst themselves. I really do think that's a wonderful concept, and leave us all alone. But the notion of the extension of the tax cuts, more bullish credit conditions for what happens with a lag effect, not consumer optimism, but corporate optimism. Business leaders, if it's the NFIB surveys, the Business Roundtable surveys, showing you business leaders are getting more confident about doing things. The one thing I'll say about the unemployment rate, be really careful looking at the 9.8% number. It's kind of a misleading figure. There are two different groups around that 9.8%. You've got people with college degrees that are running with a 5.2% unemployment rate, and then you've got people who don't have high school degrees with 16%. Your problem in labor is probably going to occur in the higher skilled areas. That's where labor costs could start edging up. Get somebody to be a dishwasher isn't that hard, and not particularly.
Doesn't cost a lot.
It's not going to force a lot of inflation. But if you want somebody to design a new computer game for your new console at home, that becomes an expensive, endeavor.
Well, I mean, one of the things also, when you talk about the structural kind of unemployment issues there, they also say that, some of these jobs might be lost forever. We talk about this every month, about how some of these, especially jobs in construction, and the older you get, the less likely you are to get hired in some of these things. Is that going to continue to be an overhang on the jobs picture there?
Yeah, but I think we talk about that constantly. I mean, I think we've talked about that for as long as I've been in the business, 24 years. As people get older, they also become more difficult to retrain with the newer developments and new technologies. Yet, I got to tell you, my 84-year-old father is pretty adept at sending emails and looking on the internet. And, people can if they want to. It's more a question if they want to.
Tobias, let me ask you, what would make you change? You said when you put out your forecast, it's kind of loose, or you're open to maybe potentially changes. What would make you change it either to the up or the downside?
I'm seeing the earnings story getting better. I think that's critical. And even if we lose some margin, earnings are still growing. We started back in September. We were looking at, when we set those targets, we were looking at about a 6.7% increase in 2011 earnings for the S&P.
Right.
We're now looking at better than 10%, and it still could edge higher.
Okay.
So corporates are being very, very efficient. And even if you get some increase in cost, it doesn't wipe it out. I don't want to suggest that, but it does take some of the steam off the market.
Julie, you wanted to bring up something with Tobias.
We were talking about these ICI fund flows, which people have been tracking very carefully. We had a bit of a reversal in December out of bond funds. It started going into equities, but more, foreign equities. And then last week, finally, as you mentioned, we had money flowing into U.S. equity funds for the first time since April. Why do you think that's not necessarily a good thing? I mean, everybody's been talking this whole time. The retail investors on the sidelines, they need to get back in.
More money's coming in.
Let's start with a few things. Number one, equity mutual funds own 20% of U.S. equities. 80. So let's not talk about the other 80%. Let's just talk about the 20. That's kind of silly to begin with. And people talk about, well, you've got money down at 3.5% on what's called liquid asset ratios for the equity mutual funds, how much cash they have as a percent of their total assets under management. Again, 20% of all the ownership, 3.5%, and you tomorrow, not even tomorrow, in a minute, you could click on your mouse and move money from your money market fund into an equity fund in a second. So why would you keep it in the equity fund?
And in the other direction as well.
Exactly.
Right.
So these are poor, they're talked about endlessly, but they're actually very, if you think about it, they're poor analytical instruments.
And you don't think it's a good proxy for broader sentiment?
Not really, because they have been putting money into equities. They've been putting into international equities the whole year.
Right.
They've been going to places like emerging markets. So it's not they don't want to take any risk. They put it into high-yield bond funds, so they obviously will willing to take risk. When they're finally coming to equities after an 88% rally off the bottom, in the U.S., are they making the right decision or are they just chasing it?
Now, what about this whole idea? People have said the Russell 2000 far outpacing what's happened with the S&P and the Dow. And a lot of strategists, a lot of analysts out there are saying, hey, that could be the next rally there is in the large cap blue chip stocks in the U.S. Is there a case to be made that, perhaps small and mid caps have seen their time and it's time now to move into those blue chips?
And I should point out Don Yakman, Bill Miller, I mean, these guys are all still arguing for the large cap case at this point.
Arguing. They've been arguing.
And they didn't do so well on it this year.
I was about to say that if you did the valuation work, it would say, yes, you should be buying large caps. Unfortunately, I could have given you that
You should be
buying large caps.
Okay.
But I could have been saying that for the last 5 years and been wrong. So valuation alone, I would say it's a necessary but insufficient condition. You need more than that. And what I think you really need, you need to see some of what we call our lead indicators. We track 330 economic series to see which lead indicators of those series with about 12-month lead are the best correlated to future stock price performance. We build an index of 10 to 15 for small cap versus large cap, still telling us small caps will do well.
Still.
But it's starting to turn around mid-year next year, right around when margins also start to turn. And that's historically when you start seeing that divergence, when you start seeing large start to take the leadership back from small.
When margins become an issue.
When margins become an issue.
So just out of curiosity, in that index that you look at, which economic indicators are most closely correlated?
I love that you asked me that question. I really love
you. Try. It's a good try.
No, I won't give you the answer for two reasons. One, I don't remember. And more, because we have 330 series, it's really hard to remember them. But I do have a spreadsheet that has all that information ahead of me, thank God for electronics. The second thing is we're actually trying to build robust models where 10 to 15 factors all contributed, because the market isn't about if interest rates go up, do this. It's if interest rates go up and there's cash on the sideline and there's a benign environment for social dysfunction, and there's this and this. We live in a very multidimensional world, so looking at one factor, I think everybody wants it, it's easy. It doesn't quite work that way, so we want 10, 15 factors all moving together.
Tobias, how does your spreadsheet kind of factor in things like Europe next year and QE2 next year?
I will tell you there are four things that I'm watching at very carefully. One is China's lead indicator. China as a market leads our markets by about 3 months. China peaked in mid-November, which means around mid-February we might have a hiccup here. Number two, I'm worried about Spanish refinancing in March. That's a big one. Number three, QE2 ends in June. And number four, margins start to soften up in the second quarter into the third quarter. I mean, these are why I talk about this kind of bumpy ride. It is not going to be an easy trajectory. Everybody wants that. You know what? I've learned a long time ago, I don't get what I want.
But it wasn't an easy ride this year. We were up and down all over the map. We had some terrific months, and we had a lot of selling. Is that now, well, I hate to say the new norm, but is that kind of the new norm for
Even the new normal has become not really the new normal.
Exactly.
With all due respect to my friends over at PIMCO.
Well, even they backed off. I mean, and
3.5% growth next year.
They brought it up.
And I think they're right. I think we're borrowing a little bit from the future by borrowing some money to essentially fund the payroll tax cuts, the extension of all tax cuts. And it's been really humorous. And I made a comment in the prior segment about let the Washington bicker with themselves. I was in Washington 3 months ago meeting with a lot of congressional staffers. And what was really funny, everybody was talking about the $700 billion figure for the upper 2% tax cut extension. Nobody ever mentioned the $3.1 trillion for everybody below that. Which is kind of fascinating. I mean, we don't have $700 billion, but we have $3.1 trillion. that's why I want Washington to bicker with themselves.
Yeah. Let's hope that they actually maybe then do something with that bickering.
Yeah, the good part is I'm Canadian. I don't vote in this country.
Easy way out. Tobias, thank you so much. We really appreciate it.
Thank you. Happy New Year.
Same to you. Tobias Levkovich, everybody.